Hello, ladies and gentlemen, and welcome to a fantastic episode of Burn Your Boats podcast. Question on our minds today is now a good time to buy? Well, of course, the answer is it depends. Are you a wholesaler? Are you a flipper? Are you a buy and hold guy? Are you small commercial multifamily? Are you large multifamily? We're going to delve into all of these issues today in this podcast. So let's get started. Looking forward to it.
Ever wonder what burn your boats means? Picture this 10, 15, 20 years from now. You are living your best life. You are not bound by the chains of a W 2 income. You're traveling, watching your children grow, being present in their lives. You're fulfilling all of your dreams and ambitions. Burn the boats is a powerful metaphor for making positive changes in life and moving forward despite challenges. It means creating a new reality by breaking free from old habits, people, and tools that hold you back. Burning your boats is when you realize your worth, your value, and you make the choice to create change. Clark and David are successful real estate investors who understand the importance of wealth creation and breaking free of financial anxiety. They believe that anyone can achieve this by thinking differently, learning new skills, and saying no to things that do not align with your goals. This podcast highlights pivotal moments and milestones in life that can set you on a new path towards realizing your full potential. Make the choice to join Clark and David and their guests as they share their own experiences and what they have learned to do and not to do in real estate investing, and share how you too can start your journey in creating meaningful wealth and live the life you deserve.
Welcome, ladies and gentlemen, to our latest episode of Burn Your Boats podcast. Today is a timely topic. We try to do as much evergreen content as we can, so it will always be relevant. But here we are in late February 2024, and it's an important question, so we'd like to hit it right on ahead, and we hope you can learn something from this. And the question for today's episode is now a good time to buy real estate? And of course, the answer to that is, Clark?
It depends, David. It depends. The elephant in the room, right?
It depends on what. So everybody out there listening we're all just one data point. We're just one person. We see the world through our eyes, through our financial situation, through our lens. And so to some people, right now is the worst time to buy since 2009. To other people, now is the best time to buy since 2009. So Clark, what gives? Who are these people? And why does everybody along the spectrum think so differently? Today, we're going to talk about a few different strategies. I remember when I was young, Clark, getting into real estate first, and I met my first hard money lender. And he told me he lent out money at 4% origination and 12% interest rate. And I remember my jaw being on the floor. I was like, who on earth could possibly borrow money at those kind of rates? And he looked at me square in the eye. He said, it just depends on your strategy.
Right.
And I didn't get it right away. Clearly, I get it now, hundreds and hundreds of deals later. But don't think we're all a monolith. There are a lot of different people with a lot of different strategies. So is now a good time to buy? Let's go through the different strategies and let's figure out, is now a good time to buy? Clark, take it away. Strategy number one. Tell me about
let's
it.
hop in. Let's get into it right away. And I think something that's key to remember is obviously just to kind of state where we're at in the market, right? We've got prices that are fairly high still from the COVID era. We've got interest rates that are still really, really high. Rents are starting to maybe soften a little bit. It seems like the water is flowing away investing into real estate right now, at least perceived on a national level. I think we know that if we want to just look at real estate on a national level, it's so kind of almost, in my opinion, it's almost irrelevant because each market is so different, right? Like if we're in the Tampa St. Pete market, does that have any relevance as to how Cincinnati's doing or LA is doing? Or I mean, they're just such different markets in terms of migration patterns, unemployment, things like that. So we have to take all that into consideration. So let's jump right into it. And I think the question is, should I buy something right now? I think our question to you, the listener right now is, well, who are you? And what are you looking to do with your strategy? So the strategy number one is a wholesaler. Okay. And a wholesaler, a lot of people probably don't know what a wholesaler actually is. A lot of times when I ask, well, what is a wholesaler? And they'll say, well, they buy something for cheap and then they just put it back on the market and then they resell it. Right. And it's true, but it's not true. Okay. A wholesaler never closes with their own money. So we're going to go back to business law contract 101, which says, David, you agree to sell me your house for, let's say, $100,000. Okay. We sign a contract. I said, I'll see you in 30 days to close. It's going to be cash. Right. And then what I do as a wholesaler is I go out to my database that I've built, that I've cultivated, and say, guys, I got this great deal. It's going to be worth $200,000 fixed up. You need, $20,000 in repairs, and I'm going to sell it to you for $110,000. So I'm going to mark it up by whatever you can mark it up. You're not getting any real estate commission. You're marking up as much as you think you can get, where the end buyer is still going to be, it's going to be beneficial, right? And then they assign their rights to that contract for $110,000, meaning that when they come to the closing table in 30 days, the end buyer is actually the one that closes on it with their money. Okay. And the wholesaler, quote unquote, makes a $10,000 fee with no money into it. Okay. So David, in this world with the topsy-turvy market, interest rates are high, now that we know what a wholesaler actually is, because I've asked a ton of realtors, what is a wholesaler? And even they don't know exactly what a wholesaler is. So is this a good time to buy for wholesalers in this current climate in early 2024?
It's always a good time to close if you're a wholesaler, Clark. It's that simple. They're not closing with their own money. They're not taking any risk. They're out there. They're marketing. They have, if you've ever driven down a street and you've seen bandit signs that said, we buy houses, or you've ever received a phone call from a overseas accent asking to sell your house, or if you have ever been solicited through your mailbox as we buy houses, any condition, that is a wholesaler reaching out to you to offer to buy your house. But that wholesaler is not the person who's going to buy your house. He's going to negotiate very, very favorable terms to him, and he's going to get your house under contract, and he's going to come to people like me. And I don't like doing that. I don't like putting bandit signs out. I don't like sending postcards in the mail. I don't like, spending all my time, hustling for deals. I like buying deals. I like renovating and adding value to deals because I feel that that's a bigger value proposition. But a wholesaler will come to me and say, David, I have this property under contract for 180. Will you give me 210 for it? That's a lot of money to a lot of people. You're like, wait, this guy's going to make $30,000. And the bottom line is, it is irrelevant. If at $210,000, that is a good deal for me, given what renovations I have to do, given what, if I'm going to hold the property or not, or I'm going to sell the property or not, given all my costs, all my inputs, all my renovations, and given what the after renovation value of the home is, that $210,000 could be a home run to me. It's irrelevant what he bought the property for. So the question is it a good time to buy if you're a wholesaler? The answer is a wholesaler never buys anything. They are just trading real estate paper. And so if you're a wholesaler right now, double down. My advice is get better deals. There are a lot of flippers and there are a lot of end users out there at the moment who don't necessarily want to engage with the market unless there's an absolutely juicy deal with a lot of meat on the bone. But if you're a wholesaler right now, double down, get busier than ever because there's more inventory on the market. There are more people realizing the market's been frozen for nearly 3.5, 4 years. There's more people saying, okay, I've been sitting here waiting for the moment. So if you're a wholesaler, get busy, get as many contracts as you can, knock yourself out. It's a great time.
Yeah. So in summary, it's you just adjust your offer, right? The market goes up, you may have to offer a little bit more. If the market gets more risky, then you make less of an offer, which means that you can sell it for a little bit cheaper to the end buyer, right? But at the end of the day, you're not closing with your own money. So your risk is only in your time and your energy and your marketing dollars spent, right? That's kind of it. So you're in a good spot in any market as a wholesaler. Let's go to number 2, okay? The fix and flip guy. We see him all the time, HGTV. You see him on all the different channels. We do it. We've done it for a long time. I would say that right now, what we've done personally, I think that it's one thing to talk the talk on here. It's another thing to walk the walk. So David, we're business partners. We fix and flip houses together. What we've done is we've certainly scaled back. We were doing 6, 8, 10 houses at a time. And now we're doing maybe 1, maybe 2, just to kind of keep our toe in the water, I guess you could say. But ultimately, it's risky right now. There's less buyers, and we don't feel at this point that it makes a tremendous amount of sense. And there's maybe other things that we can do with our time and our money spent. In essence, we've been a bit of burning our own boats, as in the title of this podcast. What are your 2 cents on fix and flipping right now?
Well, I've flipped well in excess of 750 houses, so I do know a thing or two about it. And I have to look back at the last 10 years and the environment that we've been flipping in. And so from 2010, 2008, 2010 was a great time to be buying if you had an exit strategy. So the problem in 2008, 9, 10, 11, 12, when real estate was absolutely on fire sale, was not a lot of people knew how to exit their deals. I, at that time, had a big database of European investors. And guess what? European investors also had a big currency play on the US dollar back in 2009 and 10 and 11. And so not only was real estate discounted by, in some cases, 50%, but the US dollar at that time was discounted by 30%. And so US real estate at that time was absolutely on fire sale. But if you were trying to sell to US domestic buyers, they weren't buying it. But guess what? Europeans were buying it. Canadians were buying it. Chinese were buying it. Brazilians were buying it. Argentinians were buying it. So that was just a mindset shift back then. And so flipping then that was a great time to be a flipper, but very few people domestically were. And so then we came into 2013, 14, 15, 16. And I'd say up to around 2018, flipping that was the golden era of flipping. Lots of inventory, low interest rates, lots of buyers, really great time to be flipping. And so 2018, 2019, interest rates started to tick up again. And the market was actually slowing just before COVID, Clark. And so flipping became just a little bit more tricky on the exit. But it was still a great time. Don't get me wrong. It was still a great time compared to what we then experienced. The last 3 or 4 years have been exceptional in terms of since COVID. The acquisition side, so getting the deal, became the issue. There was nothing for sale. Absolutely nothing for sale. And thousands of buyers. And so if you could get something under contract and renovate it to any kind of condition, you were in the money every single time. But we've literally flipped since interest rates went higher. The market for a flipper, and we're talking about flippers, the market for buying a home is still exceptionally difficult to get a good deal under contract right now. So the acquisition side of flipping is difficult. The general contracting, permitting, getting it built out, inflation in every aspect, higher wages, higher costs of doing everything. The the middle part of it is more challenging than I've seen it in a decade. And then we have the exit. And guess what? The exit is harder than ever before. Right. And
Yeah.
so if I were a real estate flipper, there's a really interesting analogy, and I think it's a pretty accurate analogy that I've heard a friend refer to me, who was very, very heavily flipping in 2004 and 2005 and so on and so forth, went into the downturn with a huge portfolio of flips in his world. And he said, had I just gone to the beach in 2006, I'd have saved myself $5 or $10 million. And so
Wow.
that's always stuck with me. If you have a large flipping business, you have a lot of employees, you might not want to accept the reality that flipping right now is exceptionally dangerous. Now, all flippers have different buckets. Bucket A is they buy it, they renovate it, they sell it. Bucket B might be they buy it, they renovate it, and if they can't sell it, they keep it personally. Or bucket C might be they buy, they renovate it, and if they can't sell it, they put it into some kind of fund. And so if you are a flipper and you're flipping for your own portfolio and you have the equity and the down payments to hold them, flip away.
Yeah.
If you are flipping into a long-term buy and hold fund, flip away. But if you are buying right now, you're renovating and you're placing your homes on the domestic for sale real estate market. Certainly we're in the Tampa Bay area. Inventory is starting to creep up. Days on market is creeping up. Buyers there are fewer buyers and they have more options. So if you're cutting corners, if you're not doing every aspect of your renovation beautifully, I would suggest that there's a time to go to the beach. And if you're a flipper, if you're a flipper and you've had a fair few years of flipping, you have caught a beautiful wave and you have rode it right onto the beach. Now you're safely on the beach. You might want to
Stay there.
you might want to stay there for a year or two and just put your mind to developing other skills, put your mind to building out a buy and hold portfolio. But if you're a flipper right now, I don't think it's a great time to buy. What do you think, Clark?
So I heard a couple of things. I heard it's harder to buy a good deal. Okay. It's harder to construct that good deal through contractors, price hikes, permitting, red tape, and then it's harder to resell. Where is the fun in that? That sounds like a lot of risk and not a lot of reward. Now, I can already feel like people saying, "Oh yeah, but I bought this deal a month ago and I flipped it and I made such and such money." Look, there's always going to be outliers. There's always going to be the one-offs. But I think if you're going to be doing it on a consistent basis in a scalable model, right? To make this truly a business and not just a guy out there that has a crew and is able to flip and then turn that money and then get the next one. So we're kind of talking to maybe someone that has a nice business. Maybe they've got a couple crews. Maybe they're flipping 4, 5, 6, 10 at a time, right? That is, to me, being able to try and find the deal is too hard to get a good deal. Then so maybe I pay a little bit more. Then my construction costs are always going to go over. Then it's going to take a little bit longer because of permitting issues, challenges within the municipalities. Then it's going to take even longer to sell it on the back end, right? To me, that's just a lot of risk. That doesn't mean that sometimes you take a risk and you hit a home run, but the percentages are not in your favor. So that's why we're kind of recommending to slow it down. Maybe go sit at the beach, maybe do one here, one there, just to kind of test it and see where you're at, right? The thing that I heard too, that I think people should take away from this is that if you are on a stool and you have 3 legs on that stool, right? I can buy it and I can retail flip it. I can buy it and I can keep it. I can buy it and I can flip it into a fund or something that's similar to that. Now you got a 3-legged stool. Okay, so now you're diluting your risk down to meaning that you don't have to flip and retail everything on the MLS or on Zillow. So you're diluting your risk. It's just that simple, right? But like most flippers, David, most flippers I know have one exit strategy, and that's buying the dang thing as cheap as they can, renovate it, and then put it on the MLS and sell it for as much as they can. Okay, and if that's their only strategy, that's one-legged stool. To me, that's not something that I would recommend. So I'm going to give a thumbs down to being able to fix and flip right now is a great idea if your strategy is just the traditional put on the market and let the market buy it from you with your first time home buyer or just your typical, your home buyer. So let's move on. Okay. Go ahead, David. You have something to say?
I just got to I listened to all of that, and there is one caveat. Clark mentioned right there, if you are flipping in some kind of scale, is it you have staff, you have employees, and you need to do a certain amount of business to stay in business. So you're required to do 10 or 15 flips a month or something along those lines. There's really just kind of two caveats to that concept. If you're just in your mid 20s or mid 30s and you have a deal on your hands that you got super deep, as in you can always flip one off, two off houses if you have a lot of meat on the bone. So if you inherit a house, or if somebody brings you a $400,000 house that needs paint and carpets and you can get it for 200, flip away. That's what
Right.
I just don't know how many of those, how scalable that is. So to your point, definitely, can you do a flip or two? Well, it depends how deep you got it. If you got a very, very good deep deal, I say flip away. But if you've got a skinny deal right now, profits are thin, your profit, it's a big, heavy renovation, I wouldn't touch it. I wouldn't go near it. And then you got to hit absolute ARV, which is the after renovation value. You're looking in the neighborhood. You're like, okay, well, I see the very top of that renovation value. Let's say it's $350 a foot. So if you're not placing your ARV below the top price homes that are sitting on the market right now. So imagine you've got 10 homes in your neighborhood and 3 or 4 of them are at 350 and they're not selling, and you get a couple of homes in your neighborhood and they're at 290 and they're selling in days. Well, that tells you that people in that neighborhood want to buy properties for around $290,000. So if you come in and maybe yours is a bit nicer than the 290, maybe you can get like 300. But the biggest mistake I see flippers making right now is wholesalers, we're just talking about them, give them some indication that no, look at they're looking at the highest exit strategies in the neighborhood, saying this is what it's worth. It's not what it's worth. It's more, and that's where flippers are probably most challenged right now, is what is the actual exit price? What can I sell it for? Because the data tells me one thing, but the market piling up, because the data just doesn't really tell you how many houses are not selling at these numbers. And so it's super important to realize that if you're doing one-off flips and you have a really, really great deal on your hands, probably a good time to flip. But if you're doing, flipping in scale, I would, like we said, I would go to the beach and work on other skills.
And to give you a good example, is we have 2 properties right now, fully fixed up, beautifully renovated. All the data in the world says that they're worth exactly what we have them listed for on the market, right? We've got great comparable sales that are similar size houses, similar renovations, all that stuff. And we have listed them right at that. And guess what? The market is telling us they don't care about comparable sales. That buyer doesn't give a crap how much the house sold for down the street. They are not going to buy it at that price, or at least what the market's told us to this point. And that's the scariest thing as a fix and flip guy, is not knowing what your price is that you can sell it for. And if you don't know what price you can sell it for, it's just too damn risky right now. So I'll leave it at that. Let's move on. Go ahead, David.
That's a beautiful segue, because if you are a flipper and you are buying and renovating a house in this market, it's highly likely that you're going to become a buy and hold guy.
Yeah.
And
it feels a bit like you're pissing in the wind. If you don't know what the exit price that you're going to sell it at, you may win, you may lose. That's not a way to run a business. Could you imagine just doing that in any aspect of your life? So a lot of people listening right now are wanting to build their wealth, right? Our whole concept of this podcast is through wealth creation. And as me and you both know, fixing and flipping is a job. wholesaling houses is a job just like any other W-2 job. You may think that you're investing, but if you're buying something and then immediately selling it in under 12 months, that's just a normal active income at the end of the day. But how do we actually grow our wealth? And that's through holding properties, which is the whole premise of this podcast. So let's talk about this. We've kind of shifted our buy and hold people into two categories. So category bucket A is going to be kind of the newbie investor, right? Maybe they want to get into their first rental property or maybe their second, right? And then bucket B is going to be your more experienced investor. Maybe they have 5, 10, 15, 20 properties or even more, right? So let's talk about bucket A, David. Let's say you're listening to this, you know that real estate is a good idea, but the interest rates are high, the prices are high. Should I buy something right now and make my first investment in this real estate climate? Or am I going to have FOMO because prices are going to go up higher or whatever it is? Where are you parked on this issue? Because this is a huge, I think a lot of people listening right now are like, I'm renting, or I live in a house, but that's the only house I own. I know I want to invest in real estate, but it's just too damn expensive and rates are too high. What should I do, David?
The absolutely question of the day, Clark. I have sold hundreds and hundreds of homes to buy and hold turnkey investors. So I understand their psychology. I understand who this question is directed at. If you are working at W-2 and you are in your mid-30s or early 40s, and you are trying to build a real estate portfolio so that one day you can retire on your own terms. That's what we preach here. That's how we have liberated ourselves. And with that being said, there's really two categories within that. I'll give you a perfect example. So I have a lot of clients who are work in the technology field in Silicon Valley. They're highly paid. They pay a lot of income tax. And, you know, $200, $300 of cash flow in their world is really irrelevant. And so if you are a highly paid W-2 earner and you're looking at 20 years from now is the interest rates and the cash flow, because it is important to acknowledge there is no cash flow in almost all deals out there. And I do want to touch on how fake cash flow has been created. We'll talk about that as a marketing gimmick in a moment. But there is little to no cash flow out there in the real world. Prices are high, interest rates are high, rents are softening. Don't think that you're not going to rent your house. You will absolutely rent your house. I rented a house yesterday at $3,400 a month. So, rents are softening. It's taking just a little bit longer. And you're not, rents aren't rising. Rents are stable. So if you are able to understand that you don't make your money with $200 of cash flow in year one, it's irrelevant. Where you make your money is, depreciation on the property, amortization of the loan. You make your money through inflation. You make your money through time. You make your money through taking on good debt. That's where you make your money. So if you have a well-paid W-2 job and you can absorb, $200 or $100 a month, negative cash flow even, or a maintenance item, that's irrelevant. It genuinely is irrelevant. It is still a good time to buy if you are thinking long-term.
Yeah.
However, I'll give you another example. A gentleman came to me about a year ago, and he had like $20,000, $30,000 in the world, and he had a very, very low income. And he said, David, I'm really trying to get into real estate, and I had to point him in another direction. Quite honestly, I told him he should take his $20,000 or $30,000 and try and start a small business, because he's going to get a lot more cash flow from a small business. So if you're a buy and hold investor and you're getting into real estate for cash flow today because you need it, real estate is not a good option for you if you're thinking about income this year, next year. The reason people buy and hold real estate is so that in 20 years' time, depreciation will have given you tax benefits throughout your ownership, and you will have paid off your mortgage. Inflation will have inflated your debt away and will have increased the value of the property, and your rents will have probably doubled or tripled in that time. However, if you're buying real estate right now and you're just scraping the pennies together to put a deposit together, and you really, really need that $200 or $300 of cash flow, and if something were to go wrong, a tenant move out, have some big, large expense, something like that happened, that's going to really impact you and psychologically damage your understanding of why we invest in real estate, now is a terrible time to invest if you're in that situation. If you're in that situation, I would highly recommend that you educate yourself about buying small businesses, get an SBA loan, and think about taking on a business that's going to throw off, incredible levels of cash flow. So if cash flow is your main driver and you're a buy and hold investor, not a good idea. If growing wealth and you're not thinking cash flow today, the interest rates, prices, all of that is irrelevant. That's my take on it. I hope you've learned from that.
So here's my 2 cents on that. You brought up now another bucket. So the buckets that I had were the sophisticated guy that has maybe 5, 10, 15 plus. Okay. I think that ultimately, even if you can buy in a quality area, because I think getting cash flow right now is almost non-existent, right? So a lot of investors right now are faced with a very tough question. Should I buy this asset knowing that it's going to break even, which then we know that the faucet is going to break from time to time, and we're probably going to actually have to bring some money to make the debt service whole for the month, right? If you've got 10, 15, 20 rentals, it's kind of a drop in the bucket, right? Because you've had these rentals that have gone up over the years, the rents have increased, the values have increased, which means if I have to pay $100 out of my pocket, it's such a small percentage, but then the asset is growing. I'm able to leverage it in the future, and it's in a nice area. No brainer, in my opinion. And me and you are doing it right now. Again, like I hear lots of podcasts and everyone gives all this advice, but are you actually eating your own cooking? Me and you are buying a townhouse in Tampa right now, right? We're closing in the next week. You already closed on it. I'm closing on it in a week or so. And it's brand new construction, and the rent is probably going to cover the mortgage payment, taxes, insurance, all that stuff, and break even, right? And it made total sense to buy it because it's in a great area of Tampa. It's up and coming, and I think it's going to gain hundreds of thousands of dollars of equity in the next couple of years, which is way more than any cash flow I care about, right? So with that being said, the bucket of the newbie investor, now you kind of brought up an interesting point, right? You have kind of the high income earner that is maybe trying to get into real estate, and if they have to bring $100 to the table out of their pocket, it's not the end of the world, but they've got the advantages of real estate. However, I'm going to push back on what you said, is that I'm going to use your example, a guy that has $20,000 to his name, right? And he's not making a super high income. If I was in that guy's shoes, I've actually been in that guy's shoes. I mean, $35,000 a year coming out of college. So I know how to speak to that guy. I know I didn't have more than $20,000 at the time. But most of those people are probably renting. The easiest way to do it is to buy a house. Now, here's what I had to do when I bought that house. Did I live in the nicest neighborhood? I did not. Did I have to get roommates that I wasn't super excited to live with? I had to get those roommates. But you know what they did? They cut my costs down. They cut my power bill down. The cable bill, the Wi-Fi bill is the same cost whether you have 50 people living in a house or one, right? So ultimately, if you're listening to this, you want to get started into real estate, the interest rates are high, the prices are high, I get it. However, you've got $20,000 there. You may have to move into a neighborhood that you're not as excited to move into. It's not going to look super cool on Instagram to show everyone the beautiful picture of your new house, but it's getting you started. You're learning how to rent rooms. You're getting that experience, which is so important. You can't hit a home run from the dugout. And now there's a lot of people right now, David, just sitting in the dugout, looking at YouTube, listening to the news, but they're not swinging the bat at the plate. And I don't care how much information you've obtained from news and podcasts. If you're not up swinging the bat at the plate, I don't care how much that education isn't worth anything, in my opinion. So to summarize on that, in my opinion, if you are not making a ton of money, maybe you're making 30, 40, 50, $60,000, figure out a way to be able to get into your first house and just live in it. Fix it up, get roommates, get someone to, get mom to co-sign with you. Figure out a way to do it. Know that you're going to have to delay your gratification, and you're not going to have the nicest house on the block in the nicest neighborhood, but it's not your forever house. So who cares? Live there for a year or two, learn, and then you can make the next step. If you are making a higher income, again, you can always refinance the rate later when it comes down. Buy that damn property. Stop analysis paralysis, because I guarantee you that it will go up over time. We were talking before this about, we both own houses that we bought in 2006. The market was at the tippy top of the mountain in 2006. We both own houses still from that time. Guess what? The houses are worth way more than they were in 2006. The principal's been paid way down. The rents are much higher, and it's a no-brainer, right? And it's because we get in our time machine and look. So, and then the third thing is that if you are a sophisticated investor and you're looking at assets that are break even, I think as long as they're in high quality areas, they don't have a ton of CapEx, which is capital expenditures to have to do down the road. Again, it's a no-brainer. You're going to have a bunch of your cash flow from other deals to offset any losses that you'll have, so you won't have to bring money to the table. It's that simple. That's my thoughts on buy and hold situation for residential real estate.
And so we're going to move on. That's a great answer, by the way. I like that you take a contrary view to me, that 20,000, 30,000 lower income investor and how he gets started. So I appreciate that different take. I personally would, in that scenario, go and work on a business, and you're saying, no, you can absolutely continue to do it, but and I suppose that avatar is hopefully listening to this and takes both of those and can weigh those kind of scenarios up. Commercial, small multifamily. So we're talking about quadplexes, duplexes, triplexes. Is now a good time to buy commercial, small multifamily? So we're out there. I love this space. We're out there all the time trying to buy quads and duplexes and triplexes. There appears to be two real situations in the marketplace right now. You've got large institutional multifamily. Now, this is 200, 300, 400 unit Class A buildings that are usually traded between hedge funds and sovereign wealth funds and New York REITs. And so you've got that world when we talk about large multifamily. And then you've got the kind of mom and pop multifamily investor who owns your quadplex and your triplex. And they're very, very, very different assets. And so in the large multifamily world right now, dependent on what side of the coin you were on, if you took on a large multifamily a year ago, 2 years ago with a big value add strategy, and you raised capital, you raised debt, and now you're sitting on that debt and equity that you raised, and now you're looking at your valuation. There's a lot of people who are sweating it right now because they got into these deals thinking they're going to be worth 17 million after they renovated them and added maybe $3 or $4 million worth of capital expenditure inputs, and thought it might be 17, 18 million exit, and now they're looking at cap rates that are getting higher, and that exit might be 12 or 13 million. And in some cases, there is an opportunity for large funds and other institutional investors that can swoop in and buy those assets at a pretty big discount right now. Think of your fund rises as an example that could come in and take advantage of that. So if you're in that large institutional world and you have capital, this is probably a really, really great time to think about buying. And if you're a large institutional organization, you're trying to exit right now, or you're a small fund trying to exit right now, I won't speak about things that I don't do myself. So, I don't want to pontificate too much as if I'm in those trenches. I'm not. But I am in the small multifamily trenches, and here's what I'm seeing there, Clark. And I can't wait for your 10 cents on this, because you and I talk about this all day. Your small multifamily is going to be so many of these guys are slumlords, and they bought these properties in 20 years ago, 10 years ago, 50 years ago. They've pretty much ran these things into the ground, but they're still not budging an inch. They don't need to. They have no debt. Let's grab an avatar. Let's take a quadplex that he bought for $110,000 18 years ago. He has obviously paid off his $18,000, and he has 4 units. They're each paying him $1,000 a month right now. So he's grossing $4,000 a month, and he thinks the property is worth $800,000. But we look at the underwriting, and we look at what those $4,000 of gross rents could be, and we think it's worth 400. He thinks it's worth 800. And we're seeing this all day, every single day. And that gap is so prevalent in the small multifamily world, that there is an absolute Mexican standoff happening between logical buyers who are trying to say, well, my debt is this, my cost of capital is here, so if I pay $800,000 a month, or $800,000 for this property, and it's grossing $4,000, maybe I can do some improvements and gross $6,000, but I'm still going to be making a loss of $2,000 or $3,000 a month. That's my perspective. The seller's perspective is, I don't care. I want $800,000, or I'm not selling it. I'm just going to keep on collecting $4,000 a month until somebody comes in and offers me $800,000. Clark, what's your take on that?
I mean, I wish that I could say something different, that I could provide some different insight that was for the buyer, because we're always looking to acquire these. They're such great assets, especially in good areas to acquire. The thing that I'll add, I agree with most of what you said. I cringe. I saw when you brought this topic up about kind of the small multifamily, I literally cringe, because I have these discussions all the time with these landlords, and there's always tons of deferred maintenance. If they bought them 5, 10, 15 years ago, their debt service, their mortgage payments are so low compared to how much the rents have grown. So they don't care. It's like, it's the make me sell price is basically what they're listed at, which is not even really a true seller. So it's kind of like a faux seller, because they don't even really want to sell unless you just completely overpay for it, which means that you as the buyer are going to lose money every month. And we were talking earlier about, can I buy something that is going to break even, but it's a good asset, right? It makes sense to buy. Well, in this scenario, I'm buying an asset that's extremely distressed. They always leave all the big ticket items off. Like the roof is old, the AC works, but it's old. It's going to need to be replaced in 15 minutes. And all these things, in my opinion, lead right now to a huge thumbs down on buying two units, 3 units, 4 units. These small mom and pop kind of multifamily right now have tremendous distresses. They can under rent too. So every time that they are offered up, let's say that the market rent on the property is $2,000 a month for the rent, they're always rented at $1,400. So now you're getting a tenant, right, that's been there for a long time. That tenant can't afford to jump from $1,400 to $2,000, but you paid the price that requires you to get $2,000 a month, right? Or it doesn't work. So now you're having to have all these super difficult discussions with these poor tenants. They're probably very nice. They probably kind of take care of the place, even though it's old and outdated. And now you got to find a place for them. I mean, it's just like, it's like negative all over the place. And the last thing too is that you'll notice that a lot of these duplexes, triplexes are usually 1-1s, or sometimes like 2-1s. There's not a lot of 3-2 duplexes out there, right? So what that means is that you've got a lot of these kind of transient tenants. So your turnover costs, I don't care how good the tenant is. If a tenant moves out, you have to go in, you're going to have to clean it, you have to paint, you have to fill wall, holes in the wall, things like that, where people hang up pictures. That in itself, I mean, it's $1,000 just minimum is if the tenant took great care of it. And if they didn't take great care of it, you're looking at a couple $1,000s. So now you've got a tenant that's more transient. You've got to basically go in and turn it over, which you have turnover costs. I mean, have I said one positive thing yet, David? I don't know. We can rewind the tape, but I don't know if I've said one positive thing to do it. So I'm just putting this right now in today's market in February of 2024 is a huge thumbs down. I think that doesn't mean that there's not a deal out there. Again, there's always an outlier. The person that lives on your street that Miss Jones is needs to sell that. Yeah, there's always gonna be that deal. But the main market right now encompasses horrible prices, not set up for a buyer to make any money. You're setting yourself up for failure. Keep it moving. Look in a different direction.
It's very interesting. Nobody likes writing checks for $2,000 every single month. There is a strategy where that's real, but I hope that we have covered some topics here today that will just at the very minimum get you thinking about real estate. The answer and the question was, is now a good time to buy? The answer most definitely is, it depends on your strategy. Just as a reminder, Clark and I are two things. We'll always buy and renovate and either flip or hold a good deal. So if we see a good deal, we'll always do it. That's not to say that we are, absolutely out. But by and large, we're not looking at fix and flip at the moment. I am always looking to add good quality real estate to a long-term portfolio. To your point, we can refi out a little bit later. I don't want to sign up for, I don't want to be writing large checks on a monthly basis. We're real estate professionals, so we get to take advantage of bonus depreciation. And that's really, and I think it's important that we bring this up. That's probably a big portion of our incentive to buy real estate. And, we've just gone through the end of the tax year, and everybody I know who is active in real estate was out buying like there was no tomorrow. That will taper off, I imagine, within our industry in the first couple of months of the year. But the overall reason we did this podcast today was to let you know that, over time, we're in this business a very long time, and the market will cycle in and out of things, right? We've all heard the term, it's time in the market, not timing the market. And that's true. I hold that very, very, dear to my heart. It's why I continue to buy. But I'm buying because I don't try and derive cash flow today from most of my new acquisitions. I understand they're not going to cash flow, but I'm buying them for my children. I'm buying them for when my kids are in college, are buying their first houses. And in many cases, I'm buying them for my wife, later on in my life. Lord forbid if something happens to me, so I'm buying now, not for me this year, most likely not for me ever. Why I buy real estate now is to help my wife, help my children, if anything should happen to me, that they have these assets in 15 and 16 and 17 years that will protect them, and that they'll have cash flow, and that they'll have security. So if you're buying right now and you need to make cash flow next month, we've covered that one. So Clark, I think we'll wrap it up here. Is it time to go to the beach?
It depends, David. Who are you, right? And that's I think that I will tell you though, for me. So, and I appreciate you sharing, why it is that you kind of do this. And to your question of, is it time to go to the beach? For me, the answer is yes. And here's the reason why the answer is yes, is that the reason that I buy these assets, the reason that I hold these assets, the reason I don't sell them, the reason I want to get quality tenants and make sure they're renovated well, is because over time, they do kick off cash flow, and they kick off a lot of cash flow. And guess what that enables me to do? That enables me to have freedom to do things that I want to do. David, I'm 40, I have no kids, and I'm not married. So you know what I want to do? I want to travel and go sit on a beach in Europe or South America or Latin America or wherever that is, right? And these kind of things enable me to do that on a much more consistent basis than I ever could have imagined when I had a W-2 job. So we all have different reasons for why we do this, but at the end of the day, you get to choose how you spend your time. I get to choose how I spend my time. I'm not 65 ready to retire. Like I don't want to save, work W-2 job till I'm 65, 67 and a half, and then start enjoying life. I want to do it today. I want to do it yesterday. I want to do it tomorrow. It's that simple. So taking all of these actions, these little tidbits of information have enabled me to be able to do more things that I want to do and say no to the things I don't want to do. It's that simple. I'll leave it at that.
That's very good. And always remember, we know nothing about the future. If you think house prices are going to go up or house prices are going to go down, you just don't know. Nobody knows. And so we're always operating in that void of information. And if we think long term, this is why we do real estate. So with that being said, I think this is a great episode. Well done, Clark. I've learned a lot, and I've enjoyed your perspective. That was great.
Let's do it. Thanks, guys. Thanks for listening. We'll see you next time.
You've been listening to the Burn Your Boats podcast with Clark Lunt and David Shaw. We would love to hear from you. Please reach out at burnyourboatswealth.com with comments, questions, and if you have a topic you would like Clark and David to discuss on an upcoming episode. We would very much appreciate it if you took the time to rate and review Burn Your Boats podcast on your favorite podcast listening app, and make sure to follow and share on social media. Content in Burn Your Boats podcast is for entertainment purposes only and is not legal or financial advice. Please review our legal disclaimer at burnyourboatswealth.com. Thank you for listening.